Hello everyone, this is Fahad Khan from the Morgan Stanley Global Wealth Management team. For some time now, we have been working closely with BMA in regards to opportunities in the emerging markets and have built a strong relationship around this. So when Mudassar and the team asked us to share some of our views on the space, we were of course delighted to help. Unfortunately, this time we are unable to be there in person. However, we have lined up our Chief Emerging Markets Strategist, Jonathan Garner, to share some insight via a recorded video link. The current stress on our global financial markets have led to unprecedented volatility and huge losses around the world, of which the emerging markets have not been immune. However, even in these challenging times, we try to identify opportunities and find compelling themes for the future. As the engines of global growth, the emerging markets are of particular interest, and as its role continues to become increasingly relevant to the global economy, it demands close attention. Jonathan is the head of the Morgan Stanley Global Emerging Markets Strategy team and has been covering the emerging world for over 10 years. He is author of The Rise of the Chinese Consumer and was ranked #1 for emerging market strategy in 2008 by the Thomson Reuters Excel survey. He has some insightful and significant views on the emerging world, and I hope you enjoy some of his thoughts. Thank you.
Okay, well, hello everybody. It's a great pleasure for me to participate in the BMA Investor Conference. My name is Jonathan Garner and I head up Emerging Market Strategy at Morgan Stanley, based out of London. What I'm going to do today is talk to you a little bit about the secular drivers of emerging markets, including the long-run economic prospects. Then I'll move on to the more near-term issues, what our forecasts are for growth in 2009, and then talk a bit about equity valuations, where we're priced in emerging markets and which parts of emerging markets we think are likely to outperform. I think if we start on the secular drivers for emerging markets, there are a number of these that we've emphasized in our work. In particular, the adoption of the market economy in the really big population countries since 1989, most notably, of course, in China after Deng Xiaoping's Southern Tour of 1993, technological adoption, heightened amounts of foreign direct investment, but also a tendency to invest more in EM out of higher domestic savings. All of the large emerging countries have this trend of higher domestic investment driven by higher domestic savings. And so we've had, in most cases, a reduced reliance on foreign funding of investment, which will be very important, I think, as the credit crunch continues. The other key long-run trend is, of course, urbanization and demography. Now, in urbanization, that's a pan-emerging markets trend. We're forming EM megacities at the moment, and that is very positive for emerging market infrastructure spending, something that most EM governments are focused on. In terms of demography, there's some profound differences between the emerging world. Certainly parts of Latin America and South Asia have the most attractive demographic characteristics, but overall the working age population of emerging markets is still set to rise from here out to 2050 by about 1 billion people, whereas in the developed world it's set to shrink by 100 million people. And that's very positive for equity markets. It implies a strong secular trend in consumer spending and again demand for infrastructure as these individuals enter the working population. I think improved government fiscal positions over the cycle are also an important driver of emerging markets. And again, we can contrast that with the deterioration in parts of the developed world and an increased tendency for emerging markets to trade with each other. So in fact, since 2000, emerging market exports to the US have been monotonically declining, whereas intra-EM trade has been booming. And though at the moment, obviously, the global economy is starting to slow, the key part of global trade that is holding up the best is intra-EM trade. So I think if we turn to the nearer term issues, we at Morgan Stanley are forecasting a recession in the developed world in 2009, no GDP growth at all. In the emerging world, our base case is 5.1% GDP growth, PPP weighted. That's slightly more pessimistic than the consensus that's still over 6%. And whilst there may be downside risks to our number, we think it's fair to say that pretty well the entirety of growth in the global economy next year will come from emerging markets. Indeed, it's not an exaggeration to say that we're transiting now towards an emerging markets-led global economy. Certainly there are many stresses in the current situation. The credit crunch is affecting certain geographies, countries that are still running current account deficits, or where the banking systems have been overly reliant on global sources of funding. The good news is that the major emerging economies do not have that characteristics. The largest one that does have a somewhat overlent banking system is Korea, and to a lesser extent Russia. But what we're seeing is emerging countries deploying reserves in a way, of course, that they couldn't do in previous global downturns, and many countries actually cutting interest rates rather than being forced into the kind of conditionality that we've seen historically from the IMF that forces a fiscal tightening on economies which are already slowing. So we think there are clearly challenges out there, most notably, obviously, in the exports to the developed world, which is in deep trouble. But we suspect emerging markets is going to continue to grow in 2009. Now, our base case earnings growth expectation is minus 20%. We think there will be weakness in the cyclical parts of EM, particularly IT, energy and materials. That 20% earnings recession will be similar to what we saw in 2001 and 2, but less severe than what we're expecting in the US, Europe and Japan, where 40 to 50% earnings declines now seem likely. And I think the key difference is that the banking sector in emerging markets has not got into such difficulties, most notably the large Chinese banks, and the telecom sector is still experiencing structural growth. We are priced at the moment at a price-to-book multiple of 1.3 times. I'm speaking to you on the 5th of November. I think if you look out, that is historically a very cheap level. 1.9 times is the long-run average. We're trading at a trailing price earnings multiple of about 8 times, having troughed at 6.5 in the middle of October. Again, that's way below long-run average levels of 16 times. So we feel that we're actually priced for something worse than our base case assumption. We're priced more for the 40 to 50% decline in earnings, which could happen. We have a bear scenario where 40% decline in earnings would happen, but for that we would need an outright hard landing in EM, more like 3 to 4% GDP growth and further downgrades to emerging markets growth over the next few months. So for us, the market is attractive here. What we are indicating to clients is that particularly of interest should be Asia at this stage of the cycle relative to EMEA and Latin America. In a full slowdown where commodity prices fall, Asia, as a manufacturer and commodity importer, tends to benefit. Margins get squeezed for Asian companies. They're early cycle when the slowdown begins, but before commodity prices fall. But once commodity prices fall, EMEA and Latin America, that are commodity exporters, do much less well. And in fact, the relative performance of Asia to EMEA and Latin America has started to pick up over the last 6 to 8 weeks. Within Asia, our top picks are Taiwan and China. China, in particular, you should note, has derated significantly in PE terms. It's now one of the cheapest markets in history. And policy is very much in motion in China. We've had 3 interest rate cuts in 6 weeks. We've got the suspension of bank loan quotas. We've got measures to help the property sector, cutting the down payment on property. In terms of other parts of emerging markets, our key overweights within the commodity producing areas are Brazil and Russia, and our key underweights are Korea and Mexico. So with that, I'll close my comments. Please enjoy your conference, and thanks very much for your attention. Goodbye.